Hi there, Mike Brady with Generosity Wealth Management, a comprehensive full-service firm here in Boulder, Colorado. Today I wanted to talk a little bit about the volatility in the market. I mean, you might read or watch on TV that it's up one day because of X and it's down the next day because of Y, and the journalist seems to be very confident that the reason that they've given for a complex question is absolutely right, despite the fact that the day before it might have been contradictory. Optimistic on day one and pessimistic on day two, and then optimistic and renewed on day three. It really doesn't make a lot of sense many times. When I was in college, we learned about this thing called CAPM, which is the capital asset pricing model. And a guy by the name of Markowitz came up with it, a brilliant economist. Actually received a Nobel Prize in economics in the early 90s because of it. And then his work was followed up by the work from a guy by the name of Kahneman, and the work by the guy by the name of Thaler, Thaler, Thaler. And they received Nobel Prizes 20 years ago, and another one about 5 years ago. And what they determined is that, unlike what I learned in college and what Markowitz had said, is it's not all about math. The reason why the value of an asset, in this case it could be the stock market, the bond market, it's not all mathematics. It's not just a stream of income payments in the future and the entire formula. It's an efficient market, meaning everyone's got the available information, and not everyone, though, is logical. I mean, that's really the biggest work that came out of the last 20 years, 20, 25 years, is that, go figure, people sometimes are emotional and are illogical. And so I take that into consideration when I look at what's happening right now. I mean, a lot of it has to do with some of the emotions that we have, some of our predictions, some of our fears, some of our hopes, some of our greed, some of our, real fear. And so that all kind of boils, together in a pot to get what we see on a daily basis, and then is in the news. Over the last 2.5 years, we've had, on the demand side, it's a demand and supply, but on the demand side, we've had $7 trillion helping to support the demand for goods. Whereas on the flip side, the supply has been restricted. We've had supply chain issues. You have lots of demand, lots of money with lower supply. And it hasn't been transitory. The impact of that is being inflation. And it's been exacerbated by various shocks to the system. COVID waves that have led to kind of one right after another, and then we've got Ukraine being invested by Russia. So there's a reason why it's been this inequality of demand and supply, kind of out of whack, has been extended longer than what is frankly comfortable. What we've seen, though, recently is we have the supply chain. There's an agreed upon consensus throughout the world that we need to focus on getting that fluid again. And on the flip side, demand is coming down mainly because of the inflation, the reaction to it. What I would say is the overreaction, sort of the oversold we talk about. And so interest rates are coming down, which is good, because the real estate, really kind of, with mortgage rates dramatically increasing to 40-year highs for mortgage rates, yeah, people are buying less houses. And so the demand throughout the entire economy has reduced due to some of the inflationary pressures that we've seen. But at the same time, we're seeing the supplies go up. And so they're going to be back, hopefully we've got some demand and supply coming back into equilibrium, which is what we want to see. And that's good for us as investors, of course, good for us as long-term investors as well, as things kind of start to settle down. I always hate it when there's volatility. I never mind it on the upside. You get 2 or 3 days of an upside, and we're like, yeah, right, things are back. and then we have a day or two of downs. But the important thing is as we string them together, that there are more ups than downs, and that starts to happen when things go back into equilibrium. It takes a while for it to happen. I would say that it took a while for it to come to this situation. It's possible. Sorry, guys, that's my dog right here underneath the table. But it takes a little while for it to work itself out as well. The risk to us, though, is if there is a shock, especially to the supply side. On the demand side, printing more money doesn't seem politically feasible at this point in the point in time. However, from a supply side, if we have a major shock to the supply side, that won't be good. That will derail us from coming back into equilibrium, which is what we want for that demand and supply side. Anyway, Mike Brady, Generosity Wealth Management, 303-747-6455. You have a wonderful day. Thank you. Bye-bye.